Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers, where I challenge you to replace a 10th of an hour of billing time with a 10th of an hour of learning. For today's episode 3, in honor of the July 15 tax filing deadline under the CARES Act today, we're going to cover amended returns and the 3-year limitations period granted to the IRS and the taxpayer, and we're going to examine recent Chief Counsel advice that clarifies this 3-year limitations period in situations where amended returns are filed. Now, before we look at the amended return situation, it's important to note that when there's one return filed, the law is pretty clear on the 3-year limitations period. So, whenever you file a return, usually the IRS has 3 years to assert an underpayment of tax and try to collect it from you. And similarly, when you file a return and pay your tax, you typically have 3 years from the filing of the return, or if later, 2 years from the payment of the tax, to assert a refund for any overpayment of that tax. So the big question today is, when does this 3-year clock start running? So if you have an early return that's filed before its original due date without extensions, then the 3-year period will run from the due date. However, if you apply for an extension and file a return after the original due date but before the extension deadline, then the 3-year period will run from the date that the IRS receives the actual return. Now, it's important to note that with all of these, you need a valid, non-defective, non-fraudulent return. Now, the nuances of a valid return are beyond the scope of today's discussion and would require much more than a 10th of an hour to cover in full, so we're not going to get into that topic. Now, recently, the IRS Office of Chief Counsel issued advice which clarifies when this limitation period starts, both for a refund and a deficiency of tax, in a situation where you have an amended return that's filed on extension. In other words, when 2 returns are filed, which one is treated as, quote-unquote, the return for purposes of the 3-year limitations periods. Now, if you have both returns filed before the original deadline, then the law is clear that it's still the original deadline that controls for when the 3-year limitations periods begin to run. And this is because both returns are deemed filed on their original due date. So if both returns are early, you can't preemptively start the 3-year limitations periods running. Now, it's important to note that although we're not covering valid returns, you cannot use an amended return to cure a false, fraudulent, or defective return in order to avoid penalties. Now, in a situation where there's extensions of the due date and you have 2 returns filed, that's where some of the ambiguities come into play. So, if you have an original return filed prior to the original due date, but then an extension is requested and a superseding or amended return is filed after the original due date but prior to the extension deadline, then the original due date will still control for purposes of when the 3-year limitations periods run. Now, this shrinks the amount of time that the IRS has to review the amended return and issue any notice of deficiency. However, it also shrinks the amount of time that the taxpayer has to seek a refund. So it balances out at the end of the day. Now, if both returns are filed on extension, then the date that the first return was actually received by the IRS will also control. Now, in honor of today's July 15th extended deadline for filing under the CARES Act and under IRS Notice 2020-23, it's important to note also that there's no clear guidance on how the CARES Act or that IRS notice would affect the 3-year limitations period. In other words, we don't know whether the IRS is going to treat today, July 15th, as the original due date for returns, or whether it treats today, July 15th, as the extended due date for returns. If today is the original due date, and if you file a return prior to July 15, then it's today that starts the running of the 3-year limitations period. However, if July 15 is treated as an extended due date, and you filed an early return after April 15 but prior to today, then the actual date the early return was received by the IRS would control for the 3-year limitations period. Now, it is important to note that under the IRS notice, If you had an actual limitations period that ended between April 1 and July 15th, the IRS is given an extra 30 days to take action, even if that 30 days extends beyond today. But as a taxpayer, you're given an extension only to July 15th to take any action, for example, to claim a refund if that 3-year claim period ended between April 1 and July 15th. Thanks everybody for joining me for this episode of The 10th of an Hour. Good luck to everybody working on tax filings or extensions today. And as always, if you have any questions or topic suggestions, or if you'd like a shout out on a future episode of The 10th of an Hour, please email me at griffin.bridgers@gmail.com. Thanks again, and I look forward to seeing you in the next episode.